afternoon, good evening, depending on where you're at. Welcome to our first 90-minute workshop of the year. Well, welcome everybody. My name is Sophia Bayestiwa. I work here at the Tuba City eShip Hub. On the call as well, you'll see Jennifer, Bernadine. There are new colleagues who you will find at our Tuba City. And then Raquel will be joining us here shortly. Awesome. Well, the moment we're all here for to welcome Pauline Joe as today's presenter. Pauline brings over 30 years of financial leadership experience supporting tribal nations, nonprofits, and small businesses, and has served as an executive roles, including secretary to the Commission on American Indian and Alaska Native Affairs. As president of Accounting PAEs LLC, a Native American woman-owned firm, she proves bookkeeping, tax preparation, and business consulting services. Her approach focuses on building confidence and independence through simple, practical financial systems. So help me all welcome Miss Pauline Joe today. I don't know if you guys can do your virtual applause. So just remember that today's session is being recorded. So just want to address a little bit of Zoom rules. Keep your reminders to stay on mute today. Unless you have a question, feel free to use them in the chat. We'll be keeping an eye on that today. But if you do have a question you want to voice it, just raise up your virtual Zoom hand and we will call upon you at the end of the session. Okay, but I'm going to go ahead and hand it on over to Miss Pauline here. Thank you again, Pauline, for taking the time this evening to be with us.
Thank you so much. You did great, Sophie. I truly enjoyed that intro. I also want to thank you for the opportunity to be here and to share my knowledge with all of you. And I hope that I will be able to do exactly that, to aid. And with sharing my knowledge, I hope you take that and deep-seated inside of you so you can look back on this one day and say, hey, I know that lady. So anyhow, I am Navajo and Apache. I've lived in New Mexico all of my life. I've worked with the Navajo Housing Authority for, I think, like 9 years. So I know the Navajo Nation community fairly well. I probably even have had a chance to come to your house because I was doing a lot of site visits and whatnot. So I work in accounting, or our business is Accounting PAEs LLC. We are located in Rio Rancho, New Mexico. We work with a lot of small business clients and nonprofit agencies. And they can range anywhere from small to mid-size. That's it about me, I think. And I'd like to introduce to you my colleague, Miss Joyce Shaw. She is a tax accountant. Joyce, would you like to introduce yourself?
Good evening. My name is Joyce Shoppy, and I run the tax shop here in Rio Rancho, New Mexico as well. And I work with small business owners to assist them with their tax preparation, their tax consultation, tax planning, anything related to taxes, federal taxes as well as state taxes and gross receipts taxes, and just all the different things that we have to comply with. So Pauline has invited me to share this presentation, and I'm looking forward to gaining a lot of knowledge. Pauline is just a wealth of knowledge, and I just love working with her. And thank you again for having me. And I'd love to interact as needed. If there's questions that you'd like to direct at me, or you would like some input, I'm here, knowledge for the taking. So let me know how I can help and support during the presentation.
So what today we're going to cover is a lot of the minor nuances, the Navajo Nation tax, the Form 1040, and the Schedule C. And if you have any questions, I would like if you could take a moment to think of what you are here for and share it in your chat. If I can ask Sophia or Joyce to manage that for me, please. And then if we can get a chance as we go along, we can answer those questions. Okay? So go to here. We already covered that. There will be interactive short quizzes, so please be aware. If you're not paying attention, you might not be able to answer that question. So what is tax? It's an obligatory payment into the Navajo State federal revenue system, and it's imposed by the government on workers' income and business profits. And they're also added and tagged on to certain goods and services. Now, what is levied? Every time you go to the voting poll, you say there's an educational library that somebody wants to build, or there's an infrastructure bridge somewhere that money needs bond money for. There could be a complex that's being built that's going to serve everyone. And guess where that's coming from? Every time you say yes, you're saying, hey, I will give you some of my tax, right? So that's where the tax is coming from. And it's used for public safety and community programs. And also the Navajo Nation imposes a sales tax of 6% on all goods and services. It also imposes 5% on businesses, and the businesses use their own revenues to pay that 5% tax. So just a distinction, the sales tax is for customers, your customers. You collect that tax and pay it to the Navajo Nation Tax Commission. The business community also that have large sales, etc., they also pay what we call a BAT tax of 5%. Now, you have to file both forms and make sure that you're filing them on a quarterly basis. And we also have an Arizona transaction privilege tax. And what this is anytime you step outside of the boundaries of the Navajo Nation and you sell something or you deliver or perform a service, you will be paying that tax to the Arizona state, not the Navajo Nation. So the boundary line is where the change happens. The 5%, 5.6% of the TPT Arizona tax in Phoenix or on the Navajo Nation, you're paying 6% of the sales tax. So the boundaries are very important right here. So how do I know if I'm paying for the Navajo Nation or the Arizona tax? Well, I've prepared a small decision tree for you. So, for example, if we go to step 1, are you an enrolled member of the Navajo Nation? Well, yes. Let's go to number 2. Where did the actual sale or service actually happen? Where did the exchange of good or the service happen? What happened on the Navajo Nation? Okay, let's go to step 3. What kind of sale was it? Was it a retail sale? Well, yes. So now you're responsible for paying the Navajo Nation sales tax and the junk food tax, but you're not responsible for the Arizona TPT tax. So you're welcome to use this decision tree anytime. If you are not a tribal member and you answered yes off the bat, you would want to move to step 2. Now you're paying for both the Navajo Nation sales tax, the BAT tax, and the Arizona state participation tax or privilege tax. Now, I also gave you this chart to see by Navajo Nation or by Arizona state or by the federal government. So you have these forms that you can also go by if it's a main business tax or if you're exempt and etc. Here's an example of the Form 600 that the Navajo Nation tax imposes. Where you enter the 6% sales tax information on this form and submit it. If most of you are not familiar with it, this is what it looks like. So if Jim sold 2 silver bracelets at the Winter Rock Fair. He's going to, or excuse me, forgive me, I see that error on my end. If he sold 5 bracelets at $200 each, he made $1,000 in gross receipts. He multiplies that by 6%. He has to pay that because we're in quarter one. He has to, I did it again. So he has to report it by the 15th, 45 days after the first quarter ends. Okay. The junk food tax is coming from the Healthy Nation Act of 2014, and the Navajo Nation Council imposed this tax on you to basically not penalize you, but it's for health, to get you back on a healthy diet. They wanted you to get away from the fry breads and the sugars and the sweets, etc. So therefore they imposed this tax. They said, well, if you're going to eat sugars, we're going to impose a 2% tax. Hopefully it gets you off the, all that sugary stuff and get you to buy healthy foods, which is at 0%. Now, some of you probably sell food on the reservation or off the reservation. Make sure that you separate these 2 taxes on your Square or your Sprite or your cash register receipts. So when you're collecting the tax, you're not paying the wrong tax, or you're not collecting the tax and you might end up paying for that tax yourself. Also go by location. Set your software to and make sure that it collects by location. So if you go to Phoenix for the fair, you go to the Winter Rock Bull Ring riding event that's going on in Vegas, you're collecting the correct taxes, right? Okay, so here's the first exercise. Let's take a look at this one. Put on your thinking caps. Kim runs a bakery selling cakes, breads, apples on the side. She has one part-time cashier, and she receives a W-2. The quarter is over and she has 2 days to file her taxes. Can you help her file her Form 600 quarter 2 taxes? Her gross receipts is $37,500. Do you want a moment to think about that and give me answers, or do you want to continue? Okay, raise your hand if you want to continue. I can't see them. Joyce, can you help me?
Sure.
Okay, I see one person continuing.
One, yep, thumbs up from
Okay,
someone.
good. So let's continue then. So here will be your answer.
Another thumbs up.
Okay, so the gross receipts was $37,500. You multiply that by 6%. Thank you for all the thumbs up. And also the junk food tax at 2%. So what you do is you add those 2 together, and this is your quarter report on your form. Okay, your business activity tax, again, if you're not familiar with it, looks like this. When it's filled out, it has the net source gains, which is basically your gross receipts minus your deductions, and then you pay your total tax. So on this form, you get a $125,000 deduction. We won't make $125,000 or even higher. Even if you make it at $600,000, your taxes are going to be very low because it drops it. So your total gross sales that this person or this company made was $600,000, but the deduction will bring that to zero, or back basically deducted by $125,000. They had employees of 150,000, and they also paid for 50,000 in lumber supplies. So all of those are deductions. You multiply that by the 5%, and there's your back tax. A lot of you, like I said, will have a zero balance because that $125,000 will zero it out almost automatically. This basically proves that the Navajo Nation is really saving you monies. And that's the reason for this standard deduction. When they put the standard deduction here, it was to help small businesses not have to pay such high taxes. Okay, we have another exercise for the BAT 5%. James is a general contractor. He earned $140,000 in gross receipts this quarter for extracting sand and gravel on the Navajo Nation. What is his gross receipts? It's $140,000. What is his standard deduction? His standard deduction would be 10% of $140,000 or $125,000. And then he calculates his net source gains and then applies his 5% VAT tax. So he will deduct $125,000. When he subtracts 145 minus that, it's 15 times 5%. He owes $750 in VAT tax. Easy peasy, huh? Okay, the next thing we're going to cover is the federal tax. What is new on your 2025 taxes? Well, it comes off of the One Big Beautiful Bill. This is the Trump account, and this is a new tax advantage to build long-term wealth. It grows tax-free until a child reaches 18 years of age. The parents and guardians can also set up an account, and they can input about $1,000 and also contribute to the fund as it grows. The next one is the SALT tax. That's the state and local tax. Usually what happens there is it's like a quadrupling and standard deduction. These are for states that have very high mortgage or high costing homes. So they apply this SALT tax and they can deduct up to $145,000. It was $10,000, but that changed. So you know. The digital assets is basically crypto. Those are very expensive, so I don't think we have that. What is also new, on the 2025 taxes, is the qualified tips. You can deduct up to $25,000 on the tips that you have collected. And if you know of anyone who has tips, who makes tips for a living as part of their earnings, you might want to tell them to start collecting or reporting their tips. As when you report your tips and not just pocket it and not report it, what you're doing is you're putting yourself into a higher tax bracket. For example, if you were paid for $25 an hour and you made $50,000 for the year, and then your taxes on top of that, or your tips, on top of that, for deduction, you made, let's say, $15,000 in tips. That lowers your tax bracket because it moves you away from where you were in the 50,000 range, and you drop by the amount of tips that you made to a different tax bracket. So if you're not reporting your tips, you're going to pay the higher tax as opposed to paying the lower tax. And then, Joyce, do you have anything to add on that?
No, I think we had a question. Are we waiting till the end to address the questions?
Oh, no, go right ahead.
Okay, so in the chat, we had a question that said Trump account is based on income with a question mark. Do you want to answer that, or would you like me to address it?
Well, I think you give it a stab, Miss Joyce.
Okay, so no, the Trump accounts are not based upon income. It's intended to be a savings vehicle for children under 18 years of age. So no, it's not based upon income. And I think that's the only question we have in the chat. And I'll monitor that. And as questions come up, I think it might be easier to address them while we talk about the topic, if that's okay with you, Pauline.
Absolutely. And please feel free to interject and stop me as I'm talking because I can't see you.
Okay.
Okay. Thank you. So, but Joyce is right. It's a matching fund that is, if your child is born in year 2025 through 2028, the Trump account will begin for that child immediately. So you don't have to do anything, basically apply. I guess you'd have to apply and say, hey, I have a child, and then the Trump account will start for that child. But it is limited and it ends in 2028. So for those of you that are thinking of having a child, Now's the time. Okay. So.
And the total amount that can be attributed to a Trump account is $5,000 per year.
Oh, thank you very much for that clarification.
You bet.
Okay.
And we had another comment in the chats. Will you send us slides?
Absolutely. We'd be more than happy to share these slides with you. Just send me your email. I'll give you my email at the end of this session. And of course, I'd be, just let me know and I'll send it to you.
And if you put it in the chat, I'll make a note of it as well and make sure that we have that information and compile it and get it sent out.
Yes. Thank you so much, Ms. Joyce. I appreciate that. So the next one is the qualified overtime. Now you can deduct up to $12,500 as a single. What is that word I'm looking for? If you are single and then married, filing jointly is $25,000 that you can deduct. And this is the half of the time and a half, or that portion. So if you are earning $30, your overtime is $10, only $10 is deductible. So you're not receiving a check for the $10 at the end of the year. I want to be clear. So what's going on is it goes on your Schedule 1A. You report it on that form as a deduction to decrease your taxes at the end of the year. It is in your income tax form 1040 that you will see the deduction decrease your tax bracket and increase your total amount that you're going to receive in your refund.
And if I can add to that, Pauline, this year, the One Big Beautiful Bill was put into law in the middle of the year, July. However, they are indicating that we can do it for the entire year of 2025, retroactive to the beginning of the year. And we're calling this a transitional year. Because the bill came out so late in the year, there wasn't time to modify the W-2 forms for employers to indicate the amount of that premium amount of the overtime pay. Now, I've seen several clients, and, a few of them have had employers, jump the gun, and they were able to get that information, and I've seen it in box 14 of the W-2. However, the ones that were not able to report it, you can go back to your pay stub, or any place where you can keep where that information is reported, and still take the deduction for 2025. After 2025, the transitional year is over, it will then have to be reported on the W-2 or on the 1099 NEC. Note that this also applies to self-employed individuals. So that's a little bit trickier and has a little bit different of nuances. So I just wanted to clarify that. And we also had a question in the chat back to the Trump account, if the account's mandatory or optional. And of course, it is optional. It is not mandatory. And someone also made a comment. Thank you so much for the good information. So I wanted to share that with you, Pauline, because the information that you're providing is top notch, and obviously our audience appreciates it. So just wanted to give you that little bit of feedback.
Well, thank you so much. And I think you're doing an excellent job too, Ms. Joyce. Sophia, how are we doing on time?
Yeah, so we have about 30 minutes or so left. So yeah, just wanted to let you know about that on time. I'll send over a chat about 5 till. Oh no, we have an hour. Just kidding. No, we have 45 minutes. I'm on the wrong time. 45 minutes. But I'll let you know when we're getting near in.
Thank you.
And then one quick thing, Pauline, on your other computer, is it okay if you turn, because we kind of hear an echo? So I don't know if there's a way to adjust the audio on the other device. Sorry, everybody.
How about now?
That sounds a lot better. Thank you.
Is that a lot better?
Yep.
Okay, good. Well, thank you for letting me know. I do apologize for that. I do have two computers going, so trying to get all of this in. So let's go back a little bit here. We did not cover the car loan interest. You can deduct up to $10,000. This is the loan on the car that you purchased in 2025. So here you can go up to 200,000 filing jointly as a deduction. The senior deduction, if you're over 65, I think that's the age, correct me if I'm wrong, but check the date, January to 1961. If you were born before this date, you automatically get a free $6,000 deduction. And this is amazing because I've never seen that. I think that is an excellent tax deduction for those who are over a certain age.
It is, Pauline, and I've seen it on some real-time tax returns this season that I've been preparing, and our seniors are very happy because, of course, here in New Mexico, if you fall within the limits, New Mexico is not taxing Social Security. And of course, that was something that was being examined at the federal level, did not pass. So the $6,000 was really a nice, not as good as it not being taxable, but really a really nice advantage for seniors.
I can't wait to turn 65.
Oh, well, there, exactly. Get some tax
So
advantage.
I think I'll hang up. Okay. So other updates on the big beautiful bill is the bonus depreciation. Now this is for the small businesses out there. You can deduct 100% of any assets you have purchased in 2025. It's retroactive, I believe, to January 1. Double check that, Ms. Joyce. And also, what you can do is based on your profit and loss, you can carry over some of this into next year all the way up to 2028. So you can deduct the whole thing based on how much profit and loss you need to bring your tax down to zero. So, whereas before you would have to allocate the depreciation and deduct the depreciation expense to decrease your taxes, here you're getting the whole 100%. So I think that is great. So if you've purchased computers, livestock, fencing for the farm, if you received a new delivery truck or major kitchen equipment, take advantage of this. I think it'll decrease your cash or your tax bracket quite a bit. The standard mileage rate increased to 70 cents per mile for those that file Schedule C. It's the standard mileage rate. Questions, Ms. Joyce? No?
I don't see any. Let me check the chat, but I do have something to interject. So on the bonus depreciation, just to clarify, it's 100% of your business use. There may be certain types of things that are business and personal. So if you have, let's say, a computer that's not 100% business, maybe you use it for personal too, and it's 90/10, you can, deduct 100% of the business use. And yes, it is retroactive to the beginning of the year. So it doesn't have to be, most of the things that passed with the One Big Beautiful Bill, even though it passed halfway through the year, are retroactive for the entire year. So you don't have to have purchased it after, July or whenever the date the bill was effective.
So I saw a question in there, Miss Joyce. I think
Let me
I saw.
check. Oh, we do have one. Okay. The question is, I do my taxes on Intuit Business. I assume these questions are built into their platform. Correct. If I may answer, so many software programs do have questions that prompt, these things such as, did you purchase the vehicle? I'm not familiar with Intuit's particular platform. I use a professional-based tax software from that's not Intuit. But they do have questions. You need to be very careful about the way you answer the questions. And you also, the purpose of this particular presentation is to make you aware so that if they don't have a question, or if you miss the question, or if you answer it a certain way that it doesn't provide you the result that you want, as far as the deduction, that you may call into it or find out how you need to work with the software to make sure that happens. Software is only as good as the information that you put in, and many times I've seen folks have very high expectations that the software is going to handle it, or I put the information into the software. I don't know why it did this or that. So really the knowledge, knowledge is your best bet so that you can make sure the software does what you want it to do.
That is correct. With AI, the way it is today, you have to be very careful and very specific what you ask AI to get the results that you need. I think I saw another question, Ms. Joyce.
It's a comment. I am now aware of the deductions from this module. Thanks for the information.
Of course. Happy to share. I'm glad we're helping people today, Joyce. Okay,
Me too.
the standard deduction for 2025. This is, I think, the best part of the entire session. The reason why I'm really excited about that is because the standard deductions are now permanent. The reason is I'm also excited is because that $15,750, that used to be $7,000 a few years back. And now, after the passing of that bill, the 15,750 is locked and it can only go up from there. So we get double the deduction this year instead of going and reverting back to the 7,000 that we paid in the past. And the married filing with jointly, that would be 15,000. Now it's 31,000. So that, I think that is exciting news for me because I deduct more off my taxes and decreases the tax bracket that I'm in. Ms. Joyce, would you like to cover the next two?
Sure. And let me also add on to the standard deduction. Yes, it is wonderful that it has increased. I do also advise my clients, you still have the option of itemizing, and there may be reasons that you still would want to itemize. So if you have enough itemized deductions to exceed the standard deduction, then itemizing is still an opportunity for you. So I just like, to always have clients keep that in mind, because I still do have some clients that itemize and receive a greater tax advantage. Child tax credit. So it increased permanently to $2,200 per child, and the additional tax credit refundable up to $1,700. One of the questions that I get is, what does that mean, refundable? That just simply means it can go beyond your tax. Most credits will reduce your tax if you have, a $10,000 tax liability and you have $10,000 in credits, it can reduce it to zero, but you can't go below zero unless the credit is refundable. And the child tax credit is one of them that is. So you can actually receive that in the form of a refund. So that's very nice. The other credits, if you're between the age range 60 to 63, the 401k and the 403b catch-up contributions has increased. We already covered the additional child tax credit, and of course the adoption credit has a new $5,000 refundable component to it.
Okay, great. And the self-employment tax increase, the limit increased to 176,000. And so that portion increased, FYI.
For Social Security, right? If you exceed that amount, you're capped for what you have to pay in Social Security.
Correct. Do we have any questions? No? Okay.
I don't see any, Pauline, so we can move forward.
Right. So the federal tax form flow chart. This is how I would file my forms. I would start with my Schedule C, or if I'm a farmer, I would file the Schedule F. If I am an S Corp or a C Corp, or if I'm a nonprofit, I would file a Schedule K or Schedule K1. And what that does, just FYI, those that are S Corps and C Corps, you're probably familiar with the Schedule C. Basically lists the percentages of ownership that you have, and it also will ask you for how much you make in the business. Whereas opposed, the Schedule C will report the profit and loss of the business. So you will enter your income and your deductions. Basically, any information that you have on your business will be recorded under Schedule C. The self-employment tax, anytime that you make over $600, I believe, was it? Was it 400? 400, forgive me, $400. You have to file a self-employment tax. The self-employment tax is basically Social Security and Medicare taxes. Being a business owner, you don't pay yourself and you do what is called an owner's draw. Well, what the federal tax is telling you on your profit and loss also, or your business, is you need to pay yourself, and you need to file your own Social Security and Medicare taxes. You are probably familiar with the 14 points. As you're young and you get to age 50, 60 and you retire, or maybe even younger for those who are lucky, you're earning 14 points. If you don't collect enough Social Security or enough points in those batched amounts as you're going, and you don't get to 14 points, well, they're going to deny you Medicare, and they're going to deny you Social Security when you retire. So it's so important that you report the Social Security, or excuse me, the self-employment tax every single year, or as you go along and you're making over $400. And we'll kind of go into that a little bit, and I'll show you how the self-employment tax works. We also have the Schedule 1, where you calculate any additional income and adjusting income to your Schedule C. And we'll go a little bit into the Schedule C later on, but if you do have any questions, we'll take them too. The Schedule 1A is then deducted, or another form that you will have to prepare. Now, the Schedule 1A is more on the personal side and not necessarily the business side, but it's, if it pertains to you, by all means, please prepare that. And then everything is consolidated onto your Form 1040. So at the end of the year, you will take all of these other different schedules and deductions, etc., and put them all onto your Form 1040. Ms.
We have a
Joyce?
question. In 2025, I received unemployment and my small business revenue. Do I file two returns? The answer to that is it depends. Unemployment goes on your personal return. If you file a Schedule C, which we're going to be covering here in a little more depth, that is a business schedule within your personal return. So in that case, no, you would not file two returns. However, if you're an S Corp or a partnership or some other type of entity that files a separate return from your personal return, you would in that case file two. So it's really one of those depends, and that we try not to go into too specific tax issues when we address questions, just for privacy and sake of time. But that would be an offline question that you could reach out to one of us, and we could get a little bit more information from you to better advise you.
Okay. Thank you very much, Ms. Joyce. We're going to move on because I think we have so much to cover that we may not get to all of the slides, but let's give it a shot. So here's your self-employment tax. If your business income or your net profit is $10,000, you would have to report that on your Schedule C. Because you made over $10,000, you would have to calculate the 15%, 15.3% on your self-employment and split it between your Schedule 1 and your self-employment tax. Now, the reason why you split the 15.3% is, back in the day, if you've worked before, you as an employee paid 7.65% or 7% of your taxes, and then your employer matched that 7%. Well, in a business, you're doing both. So you have to deduct it on your self-employment 50%, pay the tax of 7.65% on your self-employment tax. And then on your Schedule 1, you'd have to deduct it because that went out already. So you don't want to double tax yourself. So you want to include it on your Schedule 1 as a deduction in the adjustment portion of Schedule 1, and that's recorded onto your Form 1040. Ms. Joyce?
Yes, that's correct. It's really just to not penalize you to have to, pay the whole 15.3% because you are your own employer. It's to allow you to deduct the 7.65% of it as well. So that's correct, Pauline, and it was a very good explanation.
Thank you very much, Ms. Joyce. And so what also happens is if you're not reporting that self-employment tax, the IRS knows and you will get penalized. And it usually leads to higher taxes and penalties and maybe even like the loss on your Social Security if you're not reporting that growth, the difference in your Social Security growth. Okay.
Correct. And also just to point out that self-employment tax is paid on the net. So it's really important then when you calculate your net income, which basically is your gross income minus your expenses, you want to take advantage of all of the expenses you can to get to the lowest net income. So you pay the least amount of self-employment tax because self-employment tax is 15.3% on net. You're also paying income tax on that same profit. So it's just really important to work with someone who can make you aware, do your own research, come to, presentations like we're doing, educate yourself so that you know what business expenses you can take and just reduce that amount to as low as possible so that you can pay, the least amount of taxes possible. That's really the goal on a tax return.
That's correct. Thank you so much for that input. So now we're going to go to the qualified joint venture spousal business portion. Now, LLC spouses can opt to file a qualified joint venture and not file a partnership return form. And what a Form 1065 is very in-depth. It's a form, it'll get way into the weeds of your personal business, etc. And as Ms. Joyce had said earlier, you have the option to file 2 Schedule Cs if you want. Well, this is one of the options where you can file a 2 Schedule Cs. It depends if you qualify. Now you have to file, let me see here. You have to be married and operate the business together. And you're structured you're not structured as an S corp, you're not structured as a partnership, and you're not structured as a C corp. Then you qualify. You both also must materially participate. What is materially participate? Well, you're not just like, it's not a hobby. You're putting in the hours and you're working hard and you're in it for the profit. You're there to make profit, and those are the 2 qualifications that the IRS look for. Are they making a profit, and how much work are they putting into it? And you must both elect to file a joint return and not the treatment of the other business structures that like I had stated earlier. So if you qualify for filing this return, then by all means do. So there is a community property exception, and New Mexico, I don't think do we observe common law, Ms. Joyce?
No, we don't observe common law unless it's established in a state that recognizes it. For example, Colorado is a state. So if the common law marriage was established in Colorado and you moved to New Mexico, we will recognize it. However, it cannot be established in the state of New Mexico. New Mexico is considered one of the community property states.
Thank you so much. And so what happens is sometimes if you are in a relationship, you want to file separate Schedule Cs. Well, I think maybe Arizona or maybe another state observes this. They can file this, they can qualify for this joint venture option. And they have to file what am I thinking of? Actually, they'd have to get their percentages in order. So basically, you would have to say this is how much we're going to split 50-50, 40-60, etc. And you would file that way. So the first member, the first individual would file with the business, and then the second one, say they also work, would have to file their 1099 NECs and then file separate returns. The primary purpose for this is because you want to secure your own self-employment tax. Report it to your own pot, if you will, for your future. And that is the reason for this particular qualified joint venture program.
And if I could I mentioned New Mexico and a lot of, Arizona. Arizona is also a community property state, so that would apply to Arizona as well. I'm not sure if we have folks on from all parts of the US or if we have Arizona or, so I don't want to show favoritism to one state or the other, but Arizona and New Mexico are one of 9 community property states.
And Ms. Joyce, this is a question from me to you, audience. Can you help me to understand if my husband is not working as part of the business and I'm married, filing jointly with him, and he ends up taking a portion of my self-employment tax, and that's not fair? How does that work?
So, well, one of the things that I think is important to note as far as if you're going to file a Schedule C or a partnership, obviously determine if you're in a community property state. But I've seen it done both ways. Okay, I've seen it done where it's done as a partnership. It depends on how you apply for your employer identification number in the IRS. If you apply as a partnership, whether it's husband or wife or not, they're going to expect a 1065. If you apply as a multi-member LLC, husband and wife, you can actually do the Schedule Cs, as you mentioned, if you materially participate in there. And one of the reasons that is done is because of the Social Security tax if you have one spouse. But I will say every situation is different. And one of the strategies that I use is to not have the 2 Schedule Cs, but rather to have a single member LLC and then have the other spouse, if they're both materially participating, work within the business. And that sometimes can be a better strategy, but it's not across the board. And that's why you need to talk to a tax professional about your own situation and get advice as to what best suits you. But material participation is key, community property is key, and how you've requested your employer identification number if you are an LLC and what the IRS is expecting. Now that can change if you registered and you said I'm a partnership, but then you decide, you don't want a husband and wife is in a community property state is, it passes through to the same tax return. So in my opinion, it's really just filing a separate tax return that's all flowing to the same return. There are other strategies that are better to save from having to do the partnership return, which can be a little bit complex, as you alluded to earlier. So I don't know if that directly answers your question, Pauline, but it's not one size fits all. It's, talk to a tax professional, let them know what your circumstances are. If you are a husband and wife working in, the same business, what the best strategy is for you.
Thank you so much. And I bring that question up. Luckily, my husband's very participatory, only because of my Social Security, and what I'm looking out is for making sure that I meet that balance. And that's why I asked that question. Very good answer, Ms. Joyce. So let's go on to the next one, business structure. So as a sole proprietor, you are the business. You are the one by default responsible for the entire business. Anyone sues you, you are liable, and they can go after your house, your paycheck deductions, etc. You have no protection, basically, if you're a sole proprietor and not an LLC or an S corp, etc. If you are an independent contractor, you also have no protection. but also just FYI that you are almost a sole proprietor or a single member LLC by default. So if you are a research and development contractor, you definitely will probably fall in that category of an LLC according to the standards of the government that you're contracting with. The limited liability is not a tax status. Any of these business structures, I have to say, is not a tax status. Most people think of, oh, I'm an LLC, I'm a sole proprietor, and they immediately associate that with taxes. That's not true. This is a business structure. It's the legal aspect of your business, not your tax business, or not tax. It's not tax connected. Basically, it's a structure that you create that you say, this is what I want and how I want to operate my business. Leave the taxes out of it for now, but I have a partner that I want to file with. Is the best business structure going to be an LLC partner? Come back out of the tax and think about creating that partnership agreement. Who's responsible? What happens if something happens to me? It's not fair that we have a split 60-40 or 80-20% revenue split. I'm contributing way too much and they're not contributing. All of these need to be ironed out, and that's why they call it a business structure. You're creating the structure of the business. So be well aware of what it entails and then worry about the tax liabilities after the fact, because you will have time to, as if you iron all of this part out, you will be prepared to file your taxes accordingly. Miss Joyce?
We have a question, and and I can also comment on what you had elaborated on what you said. But the question is, how does the state of Arizona consider a Navajo LLC any different than a non-Navajo as far as liability?
There is no difference. We're talking at the federal level now. The Navajo Nation is a sovereign entity, of course, and so is the state of Arizona. So they have their own taxes associated with them. However, whether the umbrella is the federal level, when you're talking about the federal level, everyone applies. No one is excluded and treated any differently. The federal rules apply.
Okay, thank you, Pauline. And just to piggyback on what you said about the business structure, absolutely, an LLC can be, you can actually be a sole proprietor with liability protection. You can be a partnership. You can be an S corp. There are many ways to go, and that's the beauty of the LLC. You are not, you know, in a box to have to be, one thing. And I just think that many times, depending on the size of the business, again, it's not one size fits all. Sometimes it makes sense to file as an S corp, because as a sole proprietor, you cannot pay yourself. You can take draws, but you cannot put yourself on payroll. And so your income is the net profit of the business. So as your business grows and your revenue grows, many times it makes more sense. But again, talk to someone, talk to a tax professional, and get personalized advice on what works best for you as far as the tax filing structure.
Thank you very much. We'll go a little bit into that if we have time. I don't know where we are on time, so
we're at 5:10, so I think we have 20 minutes, or is there other things that are?
Yeah, well, 20 minutes.
Okay.
Do we have time for questions after 2, Miss Sophia?
Yeah, we can make that work.
Oh, very good. Thank you so much. So we'll kind of go quick a little bit. We only have 20 minutes. So the business structure. So we now have what we had talked about, the protection, the costs of being a sole proprietor, an LLC, S corp, etc. So these are the costs that would be involved. The risks are higher for a sole proprietor and a contractor as opposed to being a moderate risk for an LLC business structure. And then the S Corp is you're at a lower risk. You're pretty much covered or considered. They've gone through the weeds with you and they verified a lot of data. And so therefore they consider you a lower risk because you have partners and you're being accountable and you're filing. There's a lot more restrictions and they check up on you. So therefore you're less risk. And I apologize for these notes. They should have been for Arizona, but I don't know exactly the date of the Arizona returns, but for New Mexico, that changed. I would definitely take a look to see when your Arizona taxes are due, only because I see here in New Mexico that it did change. Okay. Schedule C, my favorite. So the first part of your Schedule C is the gross receipts. It basically is a calculation of everything that's combined in the lower sections on that form. So in this example, we're going to use Kim. Her gross receipts was $150,000, and that money came from collecting all of her everything that she made in sales from ringing up that spot that was rung up at the cash register. Any returns and allowances are in line item 2. And the returns and allowances, I would look at your inventory to make sure that if you didn't have a refund that you had to give because the cake was bad. They didn't like that it had 2 men instead of a man and a woman, right? And your doesn't look like a man. So I would take a look at that. There are rules. It's called the lower of cost or market for your inventory. Let me go into that a little bit. If your inventory goes bad and you're a baker, if the apples that we're using were rotted, it became rotted, it didn't, look good. If your eggs you had to throw away the eggs because it crashed on the floor when you were in a rush, don't throw away those items. Those are write-offs at the end of the year that can save you a lot of money. We can talk a little bit more in the lower of cost or market if you would like to visit with me or with Joyce after this session, or you can email me with questions as to what were you talking about, returns and allowances. You also have to make sure that you have enough in your budget to cover for these losses, because you won't see it's gone until the end of the year when you deduct these losses. Just so you know, please prepare a budget.
And if I could add to that,
Yeah.
in your example of the eggs and so forth, go ahead and throw them away. We don't want you holding the eggs till the end of the year and bringing them in for your tax appointment. Ha ha. Pauline said not to throw them away. We want you to throw them away. Just document the amount, the cost of any losses that you have. And thanks for the folks that laughed. It was a joke, Pauline, and I just couldn't resist. I'm sorry. When you said don't throw those away. We do have a question also. So it's not really relative to what we're talking about, but I want to take the questions as they come. So when did the Navajo Nation Form 401 start? I was in contact with the Navajo Nation tax officer, and they only asked for the Form 600.
I'd have to take a look at that, and we'd have to probably visit just to see what the situation is, because
Right.
it sounds like we need more information on that particular one. I'm not quite familiar with the details, but if they're suggesting only the 400 or the 401, I don't know. I need to look at that and see.
Right. And again, we tried to just address some individual specialized questions, especially when it comes to taxes. We need to ask questions to get the answers. So that sounds like one of them, and that's an offline question, but a really good question. So, that would be something to email us on, and we can certainly get you an answer. And if you put your email in the chat, I'm collecting emails as you're adding them for slides. So just be sure to put those in the chat, or for that particular question, put your email and we will definitely get back to you.
Absolutely. That sounds great. So the cost of goods sold, we're going to cover here in a bit, and then your gross profit. So let's go on to the next slide. This is how it would be calculated in here. If you're curious, here's some descriptions that you can use as a guide. So the next thing that we have is the Schedule C that records the expenses. So I also gave you a guide down below there for each line item. As you're going through these, you can see what item is included. So basically, like say line item 8, it'll include your Facebook ads, your printed flyers, anything that you're using to advertise your business or advertise something else that you're trying to sell. If you're looking at interest at line 16B, this would be interest paid on the business credit card Kim uses for the bakery. And also in line 17, this is Kim paying for a CPA to help with tax prep. That's Joyce, and bookkeeping software. So what I do is I prepare the taxes, I prepare your profit and loss, and then I give it your profit and loss statement with your documents that I've helped you create, and I give it to Joyce. So Joyce doesn't want to jumble through all of your cash receipts, and it's just so much easier, and it's just so much smoother for her, so she doesn't charge you like $1,000, right?
Exactly.
So our costs are nominal, by the way. And anyhow, we have the office expenses. You'll know that the office expenses are different from the materials that you purchase for the inventory that you make. Your office supplies would be anything that's on your desk, and like a trash can, small stuff of that nature. And then any supplies that you purchase, that would be for cleaning, paper towels, etc. Paper clips, it could be also supplies, but that would go under office expense up here. Okay.
We also have a comment that says, I've never seen these details. I've never seen these details since Intuit just runs me through the questions. And that's a very good observation, that yes, they just ask the questions and many times don't elaborate. And so it's really good knowledge. Knowledge is power. And we also have another comment for someone who probably has to jump off that said, great presentation, goodbye. So we appreciate that feedback.
Thank you so much. So be aware that when your Intuit is asking you questions, you don't misapply your assets for an expense. So if you just bought a brand new laptop and it's categorizing it as an expense and you say yes, you're responsible for that. We're losing monies out. Off the bat. Okay. I think we're getting close to the end here. So Schedule C, the cost of goods sold. This is what I was alluding to earlier as far as your obsolete items, your throwaways, and what you can resell. All of this goes into your cost of goods sold. So what is material is everything that you purchase, your bulk ingredients, your butter, yeast, etc. You add that to what's already on your shelf on January 1, and then anything that you pay employees would be added in as the cost of labor. Be careful. If you are the owner, do not add your own labor into the cost of labor when you're calculating this, because they won't count it. And then you also take any materials or supplies, you can add that in, and then calculate the goods available for sale. And the goods available for sale are basically everything that you could have sold but did not. And then the ending inventory and cost of goods sold. Cost of goods sold is everything it cost you to make that one cookie. Everything it cost you to put all of your ingredients to bake that cake. That is the actual cost it cost you to make that cake. That's the cost of goods sold. When you sold it, it walked out the door. Now you sold it for, you made it, say you made it for $5, but you sold it for $20. That's your profit right there, is the $15. But your cost of goods sold is the $5 that it cost you to make that one cake.
And that would be a great profit margin if you could do that.
I would be rich. We're in the wrong business, Miss.
So there was another comment. I think a
Yes.
module on Schedule C would be very helpful. And I think that that's what we're covering, but there's so much to cover on Schedule C that we could probably have a separate presentation just on Schedule C, because there is so much to cover. What we're covering now is the top part of Schedule C. So thank you for that input.
That is, yes, absolutely. And just to add to your point and having to go more in depth on the details, is just to add, the IRS will not allow you to deduct the cost of your materials until you actually finish the product. So FYI, the deductions, etc., all of that is not happening at the material side, but at the inventory, completed inventory side. That is when the deduction happens. So,
well, the deduction, just to elaborate on that, Pauline, you actually, yes, you're correct, but also they want you to recognize the cost of the product when you sell it. And that's why inventory, what you have in inventory that's not sold, offsets what your purchases are. And they just don't want you to go out at the end of the year and buy a ton of things and not turn them to sell and have a big deduction in one year, and then the next year have a huge amount of revenue. So, they try to true that up, and that's where inventory comes in. It's a complicated thing to really go into depth, but essentially it's saying that you recognize the expense when you recognize the sale.
That is correct. So also back to the Intuit, if you're including your inventory into this section, just be careful that instead of putting your inventory instead of flour, be careful. It's not going to tell you it's not human, right? So that's I like that, because now we can use that as an analogy going forward. I appreciate that. Thank you. Okay.
Mm-hmm.
Cost of Jim's jewelry. Jim created a budget. He estimated his revenue to be he created the budget. That's the idea. He estimated his revenue to be $75. It will cost him $18 to make one silver bracelet. He goes to the market, buy his stuff, and he puts it on the shelf immediately. Tax it, puts it in his system, and then he's going to make his bracelet. Probably all of you go through this process every single day or every single week or month. So this is kind of like a calculation sheet, which is probably different from yours, but this is kind of something that I thought would be helpful to you. So you could get the actual cost of how much it's costing you to make one silver bracelet. In Kim's case, if she gets a contract with the Navajo Nation for a catering service, she needs to know how much this is so she can calculate her profit and she's not losing money.
We did receive another comment from the individual who said they were requesting a Schedule C module. Now I see what's happening. So thank you.
Very good. Thank you. So now we're going to go to the cost of goods sold. Again, the profit margin. The selling price, he sold it for $80, and it cost him $22.75 to make that one silver bracelet. He made $57 profit. So now he's going to prepare his cost of goods sold. Everything that he had in his beginning inventory plus what he got, we went through that. You cannot deduct your own labor, and you can get your cost of goods sold minus your inventory. Again, how much it's costing you to make those items is what you're going after. And Joyce, that's a very good point you made, because these all have to balance, and your profit and loss makes a huge difference when you're calculating your cost of goods sold, because we can detect that off the bat. Some of the required documents that you're going to need, I've listed a lot of these right here. Again, I'm just going to take a lot more. Record keeping, please make sure that you are not boxing those receipts. Take a picture of it today, put it on your iPhone. We have OCR readers that can just take all of the data off of there in seconds and put it into your accounting system, into a filing system online for you. And you don't ever have to worry about it anymore, having it to lose its printing colors, etc., etc. So it's there for life. So you don't have to delete it. Now we have iCloud. You'll never lose your documents. Doesn't matter what the rules are anymore. You keep it forever, right? You're digitizing everything. This is what I want to get at, is the taxpayer advocate service too. The IRS can create a levy on your paycheck or your house. They can take away your business that you've worked so hard for, and you have no recourse, and you don't have any money. You don't know where to turn to sometimes. The taxpayer advocate service is on your side. They're located as a subsection of the IRS organization. They're there to protect you. They can suspend that IRS action on the large repayments that the IRS has imposed on you. They can release your truck or any levies they have on your bank accounts, checking accounts. They can stop the seizures. They act as a public defender for you, and their primary job, is to dispute settlements with you and between you and the IRS. And they want to improve the policies and procedures of the IRS. Yes. Did someone say something?
We did. We had a comment that said Genius Scan is a good app for receipts. So that's great. I love when we share ideas like that that can benefit everyone. So thank you for that.
Yes. So look for your taxpayer advocate service near you. There's always a connection. I think the nearest one would be Phoenix for you, but I don't know. You can file for free as long as your AGI is 89 or below. And the taxpayer assistance centers at the IRS, not the TAS, but the TAC, will not file the returns for you, but they will answer some questions. Small business filing forms. We filed the forms again in order for you. Whether you're a limited liability, use these forms. The multi, use this. The C Corps, these forms, etc. The deadline dates, again, for the federal government, overall arching, everybody has this extension for these have changed to October 15, but it's April 15. It stayed the same. Okay.
And just to add, the extensions for entities for S Corps is September 15th.
Oh, thank you so much. Yes.
S Corps and partnerships.
There is my email if you want to get in touch with me.
And I collected anybody that put their email. I received about 4 of them in the chat. I will get that information to you, Pauline, so you can be sure to share the slides, as well as the individual that had the question on the Navajo Nation Form 401. I took note of the question as well as their email, so that we can be sure to get back to them with, get some more information to be able to provide an answer.
Absolutely, absolutely. And so the Form 401 is a very good question. It's basically the return itself, and I would love to get together with you if you have time.
Awesome. Well, thank you both, Joyce and Pauline, for tag teaming on that. I know that when it comes to taxes, it can go anywhere. So I appreciate you giving us your time this evening. And thank you, everybody who tuned in today for our first 90-minute workshop of the year. I'm going to go ahead and close us out here. And then if anybody, I'll stop the recording. And then if anybody wants to stay on just ask Pauline any last minute questions. We will go ahead and do that. But yeah, so thank you again for joining today's workshop. We have another one coming up next week on March 24th with Cheyenne Lacey. So the same way you registered for this workshop, you can register for Cheyenne's Beyond the Studio. So if you are in the arts and you're wanting to put together almost like a portfolio or it's called a press. I think that's what she called it. Getting ideas or picking her brain on how to put that together. Join us next week with Miss Cheyenne Lacey. She'll be doing that as well. We'll be hosting her as well at the Shiprock. So you have an opportunity to come to our Shiprock location. You can also join via Zoom as well. Also, another announcement that I wanted to call out, if you want to volunteer to prepare taxes, we have VITA coming to both Tuba City and Shiprock locations. You're going to be taking a training to help people prepare simple tax returns. So on the note of taxes. So those are the opportunities with us here at Change Labs. Thank you all again for joining today's workshop with Miss Pauline Joe and Joyce.